All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our Investors Observer members only workshop. Let's get started. All right, so here's our agenda for today. We're going to look at some charts, talk about what else is happening in the market, look at the sectors and industries that are hot right now, and then the rest is member-driven content, questions, site demonstrations, things of that nature. I got a good number of questions ahead of time this week, so thank you to everybody who sent those in. You can send in questions at any time. Just say something about the workshop if you want, and then I'll put them together, and you'll get a couple of slides instead of just an email. One big thing before we get started, we have recently launched live stock prices on the site. So instead of the standard 15-minute delayed data, you can get live prices, and it will show up basically anywhere you see a stock price. So places like here or here. I don't have it currently enabled on this account, but you can click enable real-time data to get started. There is a form you have to fill out for the exchange. That is because the exchange owns the data, and they want to make sure that the people who are using it are not using it in some professional capacity. There's a different fee structure for that. But that's pretty exciting. We've been asked about that a lot, and we added it in. So that is there, and like I said, let us know if you have any questions. All right, so to the charts. The S&P 500, we're here. We obviously, I think the most notable thing since the last time we talked is this big, this big slide here, which is largely about the Fed. We had been in kind of a nice uptrend here, and we broke out of it a little bit with this decline. Today's action is encouraging, and I kind of like it. We'll talk a little bit more about what I think might happen through the end of the year a little bit later. But when this starts to happen, you worry about retesting the low here, but breaking out of this uptrend is not my favorite. But as long as we get this nice hook here and that can do something, I think we'll be okay. All right, the NASDAQ is pretty similar. The NASDAQ was not in a nice uptrend before. It had this pretty sideways pattern prior to the Fed, and then did basically the same thing after the Fed. Again, though, the NASDAQ seems to have bounced off of this support line here, so that's the kind of thing you like to see. All right, the Russell started going down sort of, yeah, it had rolled over a little bit before the Fed, but doesn't seem to have been whacked quite as hard either. So that's not terrible either. You would like to see you'd like to see it not going down but going up, but in lieu of that, this doesn't look terrible. We didn't even get to the support line here. So that's again not a terrible looking thing, just a little bit of a reset. All right, the S&P 500 versus the equal weight. This divergence has continued to get wider more recently, which is essentially it's the big stocks at the top of the S&P 500 sort of underperforming the rest of the index. The cap weighted is the blue, and the candlesticks are the equal weight. And so what this means is essentially the 495 stocks that aren't Apple, Microsoft, Google, Netflix, and maybe Tesla. The top 5 might have changed a little bit. Tesla's probably not in there anymore. Yeah, those are underperforming the rest of the index, right, the 495. And so, yeah, those stocks have also been weak all year. So some of this widening here toward the end of the year may be a little bit of tax loss harvesting. Those stocks also tend to have higher valuations, so they may be just pulling back a little bit because of the sort of higher for longer message from the Fed. All right, growth versus value, another split that seems to just continue to get wider. This is largely the same thing we just talked about, except growth in this case includes a lot of other stocks that have pretty high valuations, and value is things that tend to have lower valuations, pay dividends, be well-established companies in any case. So it's not surprising, given the Fed's posture, that this would continue to get wider. Also, this has been losing all year, and so you may have some additional selling into the end of the year as people try to do their tax loss harvesting or whatever. Now, how that tax selling at the end of the year versus rebalancing turns out is kind of interesting. It's possible people could sell for do their tax loss harvesting in this year and then buy in the new year, or they may just buy right now. We'll see how that goes. All right, so the sectors and industries that are hot right now, this list, the actual components of the list didn't change very much. Consumer, defensive, and industrials, as far as the sectors go, swapped places, and there were some slight changes here and there. It's still the same. I feel like a broken record saying again that it's sort of a telling us two stories here, in the sense that energy with thermal coal and the oil and gas stuff performing well on the short-term technical score is, typically a sign that investors are betting that the market is doing well, right? Thermal coal is used to make electricity. Oil and gas is, largely a transportation fuel. So if we need more electricity and more oil and gas, or if those companies are doing well, typically that's a sign of an, sort of economic expansion. Whereas utilities tend to be more of a thing that people buy in terms of, flight to safety kind of things. They tend to pay dividends. They're some of those well-established companies that throw off cash, especially like, electric, gas. Diversified includes things that do electric and gas. Some of them also do water, things like that. But these aren't, telecoms or something like that sometimes get grouped into utilities. They're pretty, you're pretty basic things, right? Like in terms of defensive stocks, these utilities are more in that bucket. Industrials, again, we're back to expanding economy, right? Infrastructure, operations, airports and air services, railroads. That's all like moving stuff around and getting things to customers, which again sounds like a pretty healthy economy if those kinds of industries are doing well. Or investors are expecting a healthy economy if those kinds of industries are doing well, which is what we're really looking at here in terms of rating them based on stock prices, or how the prices have been moving. Consumer defensive, back to the we might be having a recession sort of footing. Confectioners is basically snack foods, and things like Hershey's. Discount stores, brewers, right? Like those are all things that really sort of tend to be in the things people buy when they're worried about a recession kind of bucket in terms of what stocks they are. You don't necessarily need a great economy for those things to do well, but also, people can only eat so many Hershey bars, right? Like if everybody gets an extra few dollars in their pocket, Hershey bars are probably not the big recipient of that. And the same with discount stores, right? Like in a really booming economy, you might expect the discount stores to underperform some other things. And then finally, basic materials, paper and paper products, coking coal, copper. Coking coal and copper. Coking coal is used in steel making. Copper is, right, copper, it goes in everything that uses electricity or is an electronic in any way. It's, people refer to copper, the commodity, sometimes as Dr. Copper in terms of its ability to tell you about the health of the economy. So it's kind of interesting that, these things are all in the top half of our sector and industry rankings in terms of how stocks are performing. Because it's, again, right, like very much a tale of two things. Like if there's high demand for copper and steel, which is what you'd use coking coal for, that points to a growing economy. People putting their money into discount stores and confectioners points to people thinking the economy is going to contract a little bit. One thing I will say about all of these is in terms of that growth versus value kind of dynamic, these are all very much sort of in the value side. Energy maybe a little bit less, but all of these typically would be things you'd find in a sort of value portfolio. Obviously, different companies may be a little bit different inside those sectors, but typically most of the big players in these things are going to be in the value side of that portfolio. And you can find this list anytime you want on the website under stocks and then sector and industry. And what I do for this presentation is sort by the short-term technical score. And then you can see the top industries here, and you can click through to one and see the top companies or the top industries that make up the sector. All right, so what else is going on? Still very much the Fed's kind of market. They're slowing the pace of hikes, which is good. Positive for stocks anyway. That also likely signals that they are, seeing the same signs that other people are, that inflation is slowing down. Right now, pretty much everybody seems to think the hiking cycle is likely to end in early 2023. I think there's a meeting in January and a meeting in March, and it depends on who you look at, but people are generally sort of expecting that maybe that last hike in March will be the last one for a while, and people are putting that at somewhere between 25. There are some people who think 25 in January and 25 in March, and some people who think 50 and 25. Either way, rates are going up more slowly, and it seems like they're less likely to keep going up. The Fed keeps saying that the rates are likely to remain elevated for a while, right? Like, you very much in the sense, much like driving a car, you don't have to be pushing the accelerator or the brake at all times. You can also coast. You don't have to be constantly moving the interest rate up and down. You can also leave it somewhere. And what elevated really means here is above whatever the Fed thinks is the natural rate. So the Fed has this sort of weird job of trying to balance stable prices, which means really not inflation or deflation, and also maximum employment. But maximum employment doesn't mean everybody has a job. It means employment is pretty stable, and really what it means is most people can find jobs. Unemployment isn't too high, but there isn't a labor shortage, which is some of what we've seen causing inflation, right? When you don't have enough workers, companies have to compete for workers in terms of what they're paying for them. Wages go up. People are willing to pay more to buy things. You get what's called a wage price spiral. So elevated means, right, above whatever the natural rate is, where the Fed thinks you get the balance of those things. So what the Fed's trying to do right now is actually slow the economy down a little bit, actually raise unemployment to some degree, which should help bring down inflation. So when you hear people say elevated rates, it doesn't mean go back to zero. It just means above whatever the natural rate is, which there's, all kinds of schools of thought about what that natural rate should be. But yeah, that's what they're talking about when they say that. The economic data remains generally pretty good. There are some signs of cooling, but nothing looks really bad. It would be unusual in terms of sort of historical precedents for the, economy to not maybe get a little bit worse with the Fed hiking rates and things like that, right? You rarely see a 1 or 2% increase in the unemployment rate. A lot of times it kind of overshoots. So, if it goes from where it is now up to 4.5%, that would still be relatively low unemployment, somewhere around what maximum employment has meant in the past. So we can do that and not have it go to 5.5 or 6. That would be historically a little bit unusual, but it doesn't seem impossible in looking at the data. Housing is sort of the biggest exception here in terms of economic data, generally pretty good, but there's a lot of things that are just sort of broken about the housing market. We spent 10 years after the financial crisis, sort of not building enough houses for all the people we had. And then during the pandemic, a ton of people's housing situation and work situation and their desire to buy houses changed. Millennials are the biggest generation in history, and they're sort of entering their peak home buying years, and we just don't have enough homes for them. And as it turns out, no one is just selling a house to go live nowhere. People tend to sell a house and then buy another house. So even the people who are trying to trade up or move somewhere maybe can't for some reason because costs are too high. They don't want to get a new mortgage at a higher interest rate. Things like that. So the housing market is weird, but it's not as big a portion of the economy as it has been at points in the past. And also it's, I think, a less good indicator of economic conditions just because there's kind of some weird stuff happening with it that is unique to housing. Otherwise, things we're watching, developments in China, the end of zero COVID, but a corresponding huge increase in actual COVID cases. It's a little bit difficult to know exactly what the impacts there are. Reopening of China's economy could push commodity prices higher. You would kind of expect that, right? Like they would just use up more, oil and electricity and various other things as they're moving around more. But China's economy is also kind of a mess. 3 years of zero COVID policy has not really done them any favors, and they had some issues before in terms of a real estate crisis and some things like that. So reopening may help reduce the cost of some finished goods in the sense of factories should be more open and things like that. So we should have maybe fewer shortages of stuff, but there may be slightly higher prices for that. Could be where some of the copper prices are going and things like that. What the increase in COVID cases really means, I'm not entirely certain. I don't think anybody is entirely certain. And also the data that comes out of China is pretty unreliable, so it's really hard to know exactly what's happening there. I think probably what it means is a slower reopening than if they had just taken the brakes off and there was no COVID. I think in the sense that people may not live like they're living under a zero COVID policy, but they may restrict what they're doing to some degree. And then finally, we're getting to the end of the year, the Santa Claus rally, which really is not the weeks ahead of Christmas, but sort of that week between Christmas and New Year's. It's hard to predict, but I kind of like the setup that we're looking at, right? That if you think back to my S&P 500 chart, we had that decline and then up days yesterday and today. That decline put us a little bit outside of the Bollinger Band, which is a technical indicator that people use to sort of indicate overbought versus oversold conditions. And I think that post-Fed slide put us a little bit into oversold territory. So I think the rest of this, we'll see what happens, right? Like news can trump anything, but the rest of this week, we could get a little bit of a rally out of that oversold condition, which would set us up with some momentum going into that after Christmas week. Like I said, I kind of like that setup. I don't really make a lot of short-term market condition or market predictions. But given the Santa Claus rally is a historical thing that seems to happen a lot and people don't really understand why. If you had to pick a year for there to be one, I like the setup we have here. I do think year-end tax selling is a potential complication there. I'm not sure how much selling there is left, to be honest. If you're holding some of the big stocks that are down a lot this year and you haven't sold it yet, you're probably not going to. So I'm not exactly sure how that's gonna shake out in terms of everything else, but that does seem like one potential complication to this theory about how we're set up nicely for a Santa Claus rally. All right, the questions. So Marcine had a couple of questions here. She enjoyed our World Stock Market Tournament, which was, a promotion game we did along with the World Cup. You pick which stock is going to go up the most on a given day, and the winners get into a drawing for prizes. So yeah, her question was, she's not really a day trader. I'm also not really a day trader. But she had a strategy to pick stocks, and then so she was looking back at some of the winners, and of the 11 she looked at, 7 are down and 4 are up, which is not a great ratio. But yeah, I think that's indicative of the fact that those sorts of short-term market things are fun, but daily price action doesn't really relate to anything long-term. This is why our scoring system uses very different things for the short-term scores and the long-term scores. Or if you filled out the investor's profile on the website, there are cases where we say, hey, look at this score, or hey, look at this score, depending on what kind of investor you are. Because, if you're day trading, the PE ratio or some of those, valuation metrics that, the longer term investor is really interested in, they just don't matter. And in the same way, if you're a long-term trader, you're not really betting that the stock is going to go up tomorrow. I mean, it's cool if you buy a stock and it goes up the next day, but that's not actually why you bought the stock, right? You bought the stock because you think it's going to go up over the long term. And then she asked, is there always the tricky overnight trading? So there's sort of two kinds of overnight trading. One is the extended hours trading, where individual stocks trade, and that's pretty wild. A lot of times, there's no market makers, there's no limit orders, and also extended hours trading frequently is on stocks that have news. And also, most people don't trade after hours. So you've got relatively low liquidity, none of the things that normally keep things sort of, in balance are happening. And also the stocks tend to have news. It's like things just reported earnings and stuff like that most of the time. So in extended hours trading in individual stocks can be pretty wild. And a lot of those moves disappear when the actual stock market opens back up. Overnight futures trading, where you see like the price of the S&P 500 overnight, is a very different ball game. The low liquidity is less of an issue because that's a pretty big market. But the market's reaction to international events doesn't tend to be particularly nuanced. And part of that's because you're trading an S&P 500 future, right? So something might happen and it's like, well, the price of oil is going up. Well, that's good for energy companies. But it's bad for airlines. But if the only thing you can trade is the S&P 500, you're essentially betting, is this good for the average stock, or is it good for all stocks, or something like that? So the up and down there is a little bit weird because of that. And this is a particular case with the Fed and international events being major drivers. Yes, I put together this chart. So this is the advanced decliners for the S&P 500. So advancers and decliners is an indicator that people use. It's just how many stocks are up on a given day versus how many stocks are down. And if you look at the last couple months here, there's a lot of periods where basically, right, so the most the S&P 500, right, the most this reading can be for the S&P 500 is 500 stocks up. And the least it can be is 500 stocks down. And there's an awful lot of days really over the last year, but even especially in the last couple of months, where more than 400 or 450 stocks were up, or more than 400 or 450 stocks were down. That's a little bit unusual. That's very much like people are just betting on stocks sort of as a concept more than individual stocks. When people talk about high correlations, this is kind of the thing that they mean. And that's a lot of times what you see in terms of the Fed and international events. Money just flows into sort of U.S. stocks and they all go up or they all go down. There's not a lot of nuance or picking and choosing. And finally, Marcine had a question about military contracts, and which is essentially defense contractors. Yeah, General Dynamics and Lockheed Martin, those guys are not entirely pure play defense contractors, but they're pretty close. That's kind of a sector that never really seems to do particularly poorly. I mean, there have been a few periods here and there where they haven't done great, but generally those budgets keep getting funded, particularly now when world governments are sending supplies to Ukraine and they will need to finish their own stores. at some point in the future, those stocks seem like a good play just from a a funding perspective. The one thing I will say, there is some defense contractors aren't pure play in the sense of like, right, Boeing does a lot of defense work, but also has a big commercial aviation business. Oshkosh is another one. They make some military vehicles. They also make a lot of civilian vehicles. So depending on how you look at it, those are either more diversified, you're not getting a lot of defense exposure there, or they're more exposed to the real economy and less exposed to the defense sector. So if you want some diversified play, maybe the Boeing or the Oshkosh is a good way to go. If you're just trying to put defense contractors in your portfolio, those may not be the best because they have big chunks of revenue that come from something that's not defense. All right, so Rich said, I have noticed some stock options have very strange strike pricing. Example, January 23 and 24 strikes for MPLX shows strikes at 29.43 and 26.43. Can you explain this weirdness? Yeah, so let's talk about the sort of theory of this for a second, and then we'll talk about the actual practice here at MPLX. So an options contract, just generally, when it's written, covers 100 shares of the stock. Excuse me. But certain things happen, right? Like an option contract can be open for a while, especially if you think about January 23 and January 24. Those are, the Januaries tend to be the first months that get populated, and sometimes they go, I think there are 2025s on the board now at the end of 2022. So those can go out a pretty long time. But companies do stuff during the course of those option contracts, stuff that might change what, the value of 100 shares today might, right, that 100 shares might represent something different at some point in the future. So things that could change that are like spinning off some business unit, a stock split or a reverse split, being acquired in a non-cash deal or some other unscheduled business transaction. A cash deal is pretty easy because there's a dollars per share amount, and it's pretty easy to just mark all the open options contracts against that dollar per share. But if somebody comes in and says, hey, I'll buy your company for, for every share you own, I'll give you 2 shares of my company and, 75 cents, that gets to be kind of messy. So in those cases, you get what are known as contract adjustments. So the Options Clearing Corporation keeps track of these. Their website is, I think it's theocc.com, and you can look them up there. But I went ahead and looked up the MPLX one earlier. So they actually, made this announcement last year. But again, it only applies to the Januaries, the only ones that are still in force. So this doesn't apply to regular dividends. This only applies to special dividends. So companies that pay like a regular quarterly dividend won't typically be subject to this. But the way to read this is, okay, so this is the date that the adjustments of the contracts happened, November 10th of last year. Multiplier means how many, right? That is how many shares are covered by a contract. Still at 100. The contract multiplier is 1, right? One contract is one contract. Strike prices. So in the case of a special dividend, strike prices get reduced by the cash amount of the dividend. So in this case, they paid 57.5 cents rounded to the nearest penny. For example, a strike of $3 will go to $2.43. A strike of 39 will be $38.43. So if we go back to, I think it was Rich's question here, 29.43, 26.43. Those were even dollars, and then they got knocked down by that dividend. That's what happens there. So when you see weird strike prices like that, a lot of times it's a special dividend. Sometimes it's a split. The strike prices get adjusted for special dividends. Other transactions are treated differently. So for splits and reverse splits, they'll change that multiplier. So if a stock splits 2 to 1, 2 for 1, then those contracts that were opened before the stock split will each be worth 200 shares. If the stock does a reverse split, you know, maybe, you know, if it's a 1-for-2 reverse split, then, you know, maybe your contract will be worth 50 shares. And then, yeah, the M&A activity and the spin-offs and stuff like that can get really weird. I've seen where it's like, all right, well, so you gotta, to try to figure out if your option is in the money, you gotta add, you know, 150% of the price of one stock and 75% of the price of another stock, and then some cash amount on top. Yeah. As somebody who shops for data to try to keep all this stuff straight, yeah, it's very easy to do on a one-off basis with a calculator, but trying to do it like programmatically, buying the data is very difficult. I'd love to know how the like options exchange and brokers do it, because it's nobody that I have found really sells a good data set to do this. All right, so Kevork asked, could the FDA calendar be sorted by stock symbol or by status, for instance, phase 3, phase 3 trial? So I'll add sorting by symbol or company name or something like that to our development queue. That shouldn't be super hard. Status is a little bit more difficult just because there's a lot of variation in terms of like, sometimes there's a phase 1 trial, or sometimes they do phase 1 and 2 at the same time. And then sometimes they break phase 2 into like 2A and 2B. So that one will probably take a little bit more work and just thinking about to trying to get it right, but it doesn't seem like it's impossible. And since Kevork asked, we have a lot of exciting stuff going on with data in 2023. We just added the real-time pricing. We've also been working for the last several months on a lot of other sort of behind-the-scenes stuff that, yeah, you probably won't notice when it goes live, but it's laying a foundation so that we can start adding a lot of new cool features and stuff going forward into 2023. So I'm pretty excited about 2023, just in terms of what we're going to be able to roll out in terms of new products and features. All right, so Dot said, I would appreciate a summary of the way to profit by selling puts. What general advice do you offer? Really the most advantageous stock characteristics to sell a put. In general, what should the option, or should the option be? I think it should be held until it expires worthless. When should one exit a sold put? How do I secure the listed maximum profit? And in tracking the status of the sold put, is a negative amount a good sign, or in a plus amount a bad sign? All right, there's a lot there, but I broke it up into bullets. Let's go through these one by one. So first of all, a sold put is, from a risk perspective, basically the same trade as a covered call. Above the strike price, you keep the credit and you have a cash position, right? That's exactly what happens at a covered call. The stock is above your strike price at expiration, your stock gets sold, you have a bunch of cash, and it now includes the amount of money you got for selling the call. Below the strike price, you're long the stock, and your cost basis is something less than the actual price of the stock when you bought it, because you got some credit up front. So, right, like all of the same things about a covered call and a short put are the same as far as that goes. A good stock for a covered call and a good stock for a short put will be basically the same. One possible exception here is dividends. If you're selling puts, there's no chance you're going to collect a dividend. Also, your option is unlikely, your option won't be assigned early ahead of a dividend. Your option can be assigned early ahead of a dividend in a covered call. Also, you own the stock in a covered call, so you may collect a dividend. One thing that is nice about the Fed raising interest rates, and I know after the 2022 investors have had, there are only a few things that are nice about the Fed raising interest rates, but with a sold put, you have to keep some amount of cash on hand, and cash generates interest now. So, if you're trying to look at like a, comparing a sold call or a covered call versus a short put on some stock that doesn't pay a dividend, the short put suddenly becomes more attractive because you can earn some interest on that cash. Whereas if you're just buying a stock that doesn't pay a dividend, you're not getting a dividend. You're also not getting any interest. But yeah, a good stock to for either a covered call or a short put is something that you don't mind owning, right? If it falls a little bit, you don't mind having to buy it. But also it has a little bit of volatility to it. So that's a little bit weird. Just in the sense of like most people don't want to have a long-term holdings in volatile stocks. But what this really means is like you don't necessarily want to do covered calls on biotech or something like that. You also probably don't want to do covered calls on insurance, for example. Biotech is a little bit too volatile. Those stocks can go way up and way down, and selling a covered call puts you on sort of the wrong way of both of those, or selling the put can put you on the wrong way of both of those. Stuff like technology is pretty good here. Energy also, right? Like, your ExxonMobil goes up and down some, but ExxonMobil is unlikely to go away in the next 3 months. So something like that can be good choices for covered calls. Right. So when should you exit? Certainly to capture the listed maximum profit. That assumes the value of the option goes to zero. So that's holding it through expiration and having it expire worthless. But since you're essentially short the option, you can close it early anytime when the price goes way down. In the case of a short put, this means when the stock goes up. So if you sell an option for $1 and then the stock goes way up, and you can buy that option back for 25 cents or 10 cents or 5 cents or whatever, that may be a good idea. You can go open a new trade. That way it frees up your capital a lot faster that way. A major difference between a short put and a covered call is that the put price will go up when the stock goes down, and the call price goes up when the stock goes up. So in a short put, if the stock goes way up, that gives you a good chance to exit because the option price will go way down. In a call, the price goes up, so you have to buy it back, and you end up basically trading cash out of your portfolio for essentially you can recapture the appreciation in the stock price. So with a short put, I would really look at closing them early when the stock went up, whereas I don't typically do that with a covered call. The thing that I'll do with a covered call that doesn't work with a short put is if a stock goes way down, as long as I'm fine holding the stock, sometimes I can buy that call back for 10 cents or a nickel, and then I can sell another call sooner that way. So that's sort of the difference there, is how you would manage them like that. And then, to reiterate, the maximum profit is the premium amount. It's exactly the credit you get for selling the put. So to secure the maximum profit, the put would have to expire worthless. And then in tracking status of a sold put, is a negative amount a good sign or is a plus amount a bad sign? That depends a little bit on what you're looking at. If you're just looking at the price of the option, negative is good for you, right? You're short the option, so you want the price of the option to go down. If somebody actually has a value of your position in some way, that could be bad to see somebody going down. Going down would be good. So it's hard to answer that question without knowing exactly what number it is that you're looking at. All right, that's the end of the questions I got ahead of time. Thank you to Marcine, Kavork, Richard, and Dot for sending those in. Those were great questions. And you can send in questions too anytime. Anytime you send them in. A lot of people will reply to the workshop invite with a question they have too. That's another way to get them in, and you get hopefully a more complete answer that way. All right, let's see. We have a question here. It says, who moves the market in the futures of, say, SPY? Who's trading after market? So SPY is an ETF, so it essentially trades like a stock. But the SPX, the S&P 500 futures, sometimes those are abbreviated as like /ES is another thing that you see. That's a future symbol. It can be anybody. Certain investors certainly can. I'm not going to be, I don't trade a lot of overnight S&P 500 futures. I'm also not going to be trading it in size to move the market. It's hedge funds and other large investors, generally, in the same way that's who moves a lot of, anytime you have a lot of money moving around, it's typically bigger investors as opposed to smaller investors. It's not, but yeah, certainly in the overnight S&P 500 futures, the number of retail traders who are pushing that around is pretty small or none. All right. Well, I'm waiting for more questions to come in. This is being recorded. We will post a link to watch it tomorrow on the website. And then we'll send you an email with that link also. The slides will also be available to download if you're interested in that. And our next workshop will be on 3 weeks from today, which I believe is the 11th of January. Yeah, Richard, we do these every 3 weeks. You can send in questions ahead. If you have questions between now and then, and you're okay with an email answer, you can use the help button on the site. It's not just for tech support. We certainly answer questions there as well. Okay, yeah, if you just got on, just to reiterate, we did. This is being recorded, and we'll post a recording tomorrow. So James said, can you explain the difference between option volume and open interest? So volume is essentially the number of contracts that have traded today. So everybody starts the day with a volume of 0. And then the volume number goes up during the day. It won't go down. It only goes up during the day. Open interest will change from day to day, but doesn't change during the day. Open interest is how many contracts were open at the start of trading today. And so in the simplest example, if there's a brand new option contract and I buy 100 contracts today, immediately after that, we'd start the day at 0 for volume and 0 for open interest. After I buy my 100 contracts, we would have 100 for volume and 0 for open interest. And then tomorrow, before the market opens, we would have 100 for open interest and 0 for volume. And then whatever happened during the day, that number could be added to open interest or subtracted. So if I decided to say close half of my position the next day and nobody else is trading that option, open interest might go down to 50 the following day. So open interest is the number of contracts open at the start of trading today, and that number won't change during the day. Volume is the number it's just like stock volume. It's the number of, except it's contracts instead of shares. It's the number of contracts that have traded that day. Michael, I'm not 100% sure I understand your question. Have an interactive brokers account and an Investors Observer account with the same email. Yeah, I don't understand exactly what it is you're trying to do. I don't know if you can either elaborate here or send us an email with your question. because yeah, we might be able to sort that out in a one-on-one a little bit easier. All right, so we got a bunch of questions here. So Dorothy says, which of the Greeks are most important for options? It really depends on what you're trying to do and what it is. Yeah, I mean, people have really complicated strategies that use all kinds of, the basic Greeks, and then there's some newer, even more complicated ones like Vanna and some like that. But yeah, those are, yeah, I don't think there's a lot of retail investors trading using those. The big one that I feel like everybody should probably have some understanding of is delta. That's the easiest one to understand, and it's a little bit of a double threat in that it can mean two things. So delta is a measure of how much the option price will go up for a $1 change in the price of the stock, or whatever the underlying is. And so an at-the-money option will gain roughly 50 cents for every $1 change in the price of the underlying. An option that's way out of the money will gain way less. An option that's way in the money will gain a lot more. An option that's really, really deep in the money will gain $1 for every $1 the stock gains. That's how delta works. So the other thing that delta does is it will give you a rough idea of the probability, or the probability that the market is assigning to that option expiring in the money. So if you think about probability, right, like 0 means no chance, 1 means something approaching 100% chance. So if an option has a delta of 1, it's going to be very far in the money, and it's very likely to be in the money at expiration. An option with a very low delta is relatively unlikely to be in the money at expiration. That at the money option, where it's the delta is a 50, that one is it's 50-50. That's exactly what that means. So delta is really the big one. Theta is probably the other one that I look at from time to time, and that is the dollar amount of option premium that the option will lose every day. And so those are probably the two most important ones. Yeah, the ones beyond that are for people who really, really like math or are showing off somehow. Yeah. So James says, for open interest, is there a way to know how many are long and how many are short? James, for every long, there is a short. So no. Right? Like if you sell an option, somebody else bought it. So that's one long and one short, and it's one on the open interest. If you buy an option, somebody else sold it, it's one long and one short. And so that's also one on the open interest because it's one contract. Richard, the emails we send, yeah, the investors keyhole emails, which come out 4 times a day, those are all going to be vertical credit spreads. Mostly they're bull puts. Occasionally it's a bear call. And then that's most of the emails we send that have an option trade. The morning update has a covered call in it, but we don't really do a lot of other trades by email. And so Charles says, are you planning on doing more managed options next year? There have been very few. Yes, we are planning on doing more next year. And really the reason we've sat out so much of this year is that the market was terrible. And our strategies don't really lend themselves well to this kind of market. And we would, yeah, I personally would rather not publish trades than publish trades that I didn't feel good about. And so, yeah, we've been light on trades because of that. Certainly, if we had a quota we were trying to hit, we could have published more trades, but I wouldn't feel good about publishing trades that I, didn't expect to win. Even the trades I expect to win or feel good about don't always win. So I certainly don't want to put anything out there that people might follow that that's going to lose somebody money or that I don't feel very good about. So that's why we've been light on trades. I am optimistic that we'll have a better situation going into 2023. And yeah, hopefully we'll get more trades out. All right, I'll give you guys a few more questions to put in, or a few more minutes to put in questions if you have them. Otherwise, yeah, I'll go ahead and start to wrap up. I already told you it's being recorded and we'll send out the replay tomorrow. That real-time pricing is available. You can find it on the stock pages or the My Account page. Yeah, otherwise, Merry Christmas. I will talk to everybody in the new year. Thank you for coming today, and thank you for subscribing to Investors Observer.